How can your bank account make you money? The answer? Yeah, it can. And I'm not talking about interest. Hi, my name is Sam Woodrow and welcome to Elite Body and Mind. On this channel, we improve your overall lifestyle. So, if you're new here, consider subscribing down below and hit the bell notification so you become part of the EBM community. So, I have a question for you. How many bank accounts do you have? 1? 2? 3? Well, today I'm here to tell you why your money is going to work hard for you, not you work hard for your money. The first thing you need to do is to create 11 bank accounts. The first bank account we are going to call headquarters. This is where all your money is contained. Every piece of income that you have goes into this account. Your salary, your investments, any side businesses, any income you have must go into HQ, the first bank account. For tax purposes, your account needs to be an LLC or some other kind of business account that has tax advantages. You should not have a HQ that is a personal account. HQ has all the money. It needs to pay out. So the second account that you're going to create is going to be called taxes. You are going to have to pay some kind of taxes. So, to be quite conservative and make sure everything is paid for on time all the time, put 22% of your money, more if you have to, but at least 22% from the HQ money into the second account, which is taxes. This should pay for your property tax, your income tax, your car tax, any other tax that you have. It should pay for everything, and hopefully you have a little bit left over. The third account that you need to create is going to be called expenses. Now this needs to pay for your rent, your mortgage, your food, your clothing, any kids that you might have. Anything that costs you money goes into this account and is paid for from this account. Now, this should contain 48% of your total income. So each month, HQ, so headquarters, the number one account, should pay 48% of your overall income into the expenses account. And it should pay for everything. So that adds up to 70%. Both accounts paying out from HQ, 48 and 22%, 70% total money going on taxes and basically lifestyle expenses. Live on 70% of your income. If you can't live off 70% of your income, go and earn more money. Go and get a second job. Go and create a side business that you produce profit from. Something that gives you more money. You can either do that or you can start subtracting your costs. So start reducing how many times a week you go out for a meal. Start reducing the clothes that you wear and how many times you buy new shoes or new jackets or new t-shirts. Start reducing your costs. There's an interesting saying. When things don't add up, start subtracting. With this financial strategy, you must be disciplined and you must be consistent. So, make sure no more than 70% of your income goes out on expenses. The fourth account is called investments. Now, in my opinion, this is the most complex of accounts because it subdivides into 3 extra, call them mini accounts. So, let me break it down for you. The investment account from HQ receives 10% of your overall income every single month. It then splits and gives 3.3% to each separate account. So 10% divided by 3, 3.33 recurring, okay? These subdivision accounts, in my opinion, should be for real estate, business investments, and a stock portfolio. Each one should be invested automatically. You'll be amazed at the wealth creation that can be created from these 3 accounts. Obviously, you can put more accounts or less accounts, but don't put all your eggs in one basket, because if it flops, you don't have any investments. So how do you actually invest the money in the 3 accounts? Well, first one I'm going to tackle is the property portfolio. So, in my opinion, you do not have to follow this advice if you don't want to. However, in my opinion, once you have got enough money to put a deposit down on a house, then go and do some research in either your area or an area close by that has a good, solid, for years and years and years, property market. There will be one around your area, I guarantee it. You then need to find a house that is, 1, it's for sale, and 2, you can buy below market value. You do not make money in real estate or property from buying the house at market value. You do not make money when you sell the house. You make all or most of the money when you buy the house. So do not buy anything at market value. It might take some time, yeah, but that is a gain. Then, once you buy the house at below market value, you do it up to a very good standard or a decent standard within the community, and then you remortgage the house if you're going to rent it, and obviously sell it if you just want rid, but I would suggest renting it, and you use what is called the BRRRR principle. B-R-R-R-R principle. Type it in at Google. There's a brilliant website. I think it's the 2nd or 3rd one down. It'll talk to you all about the BRRRR principle. In a nutshell, you buy the house, you repair it, you refinance it, and you rent it. Very, very simple. Just go, have a look, see what you think. If you don't like it, fine, don't bother. But that is my suggestion to you. The second account, which is the stock portfolio, is 10 times easier. Now, what I personally do, depending on your preference, is either invest the 3% automatically every single month in the S&P 500, the FTSE 100, or the FTSE 250. I would leave everything else alone. Forget 99% of the market, invest in 1 or maybe even 2 of them indexes and pay the dividends back into it. So what happens when you get a stock? The company pays out dividends. If you receive a dividend from that company, there's a scheme that you can do, automatically pay it back into that index, so say the S&P 500, you pay and pay and pay, and eventually you'll receive more and more and more dividends, and you become very, very rich over time. The third account should go towards some kind of business venture, and if you're not businessy, it's fine, it doesn't matter, this is only my opinion. But if you do fancy something on the side from your job, then I'd suggest going to a business that is well established and you can own. This is not like a stock investment. You actually have to work and do something within this business. I would suggest getting at least 26% for legal reasons, because it gives you more power, and as much as 50%. I wouldn't buy the whole business because you don't want to work there full time, but I'd buy enough to have quite a bit of control. At least 26%, but no more than 51%. The two major things I consider when you're investing in a business is, one, is it profitable and is it established making money? And two, does it have any or little debt? If it ticks both those boxes, then go and investigate further. However, if it doesn't, leave it alone. Don't even touch it. On to the fifth account. You need to have some kind of debt clearance. The fifth account needs to clear all your credit card debt, any mortgage payments, any unforeseen expenses. Everything goes in there. Everything is debt clearance. So you should, from HQ again, pay 10% of your overall income specifically into this account. This account clears all your debt. First thing you need to prioritize is the highest interest debt, then work down from there, and eventually you will be debt free. A little bonus tip, once you are debt free, then I would suggest you putting this 10% into the investment account and making that 20%. But that's up to you. The sixth account you need to have is called a rainy day fund. 7% of your overall income should be in this account. So from HQ, it should pay 7% into this account at all times, every single month and every single year. So this account is for emergencies. So your car breaks down, your mortgage, your interest rates go sky high, like 2008. Your daughter has a wedding coming up and you can't find the money to pay for it. Anything that's an emergency, you can pull from this account. However, you should create an obstacle that prevents you from getting the money from the ATM. Just make an obstacle. My suggestion to you, either put it in a savings account or put it in a premium bonds. One, there's massive interest compared to just a general account. And two, it's much harder to withdraw money from. The point of having this account is to resist any temptation that you have to draw money until it must come from somewhere, and then you can draw money from it. The final account is the best of them all. This is called Blow It. Put 3% of your overall income into this account every single month, and you can do with it whatever you like. So, you want to go for that meal? Go for the meal. You want to buy some new shoes? Go buy some new shoes. This is the account that you can have fun with. This account doesn't really matter. 3% of your income you can spend on whatever you want every single month. Doing this method will allow you to, one, have fun, because that's what life's all about. Have some fun and be happy. Two, become rich. And three, it creates discipline and consistency. If you make sure everything is automatic, there is no excuse to not be disciplined and not be consistent every single month. Now, I understand that what I've explained is quite complex. So, if you look on your screen now, there's a simplified graphic that shows you from HQ all the way down, from tax to expenses to investments to debt to rainy day and the blow it accounts, or as well as the investments accounts split up and what percentage should be in each. So take a minute, maybe pause the video, write this down and show your family and friends and show your bank manager how this is going to work. If you enjoyed this video, please remember to subscribe down below and hit the bell notification so you don't miss anything. Also, check us out on Instagram to become part of the EBM community. There's a link in the description. But until next time, as always, thanks for for watching.